Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the labor market, and of course, we will discuss the implications for Bitcoin as well as the general crypto market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, essentially, we just got a lot of labor market data over the last week, and it always is a very interesting time. That first week of the month where that labor market data comes in, because oftentimes the markets will react accordingly. And so we'll get to the markets, but what we've got here is an unemployment rate at 4.1%. So a really nice pullback by the unemployment rate from a high, a local high recently of 4.3%, then 4.2, and now 4.1. And I believe it was actually not even that far off to being rounded to 4%. I think if it had just been a little bit like a tenth lower or something, it might have even been 4% for the unemployment rate. So it only just barely made it to being 4.1%. So all in all, that is a good move for the labor market. Now, the question though, and we talked about this ahead of time, was that after the first rate cut, if there's no clear and obvious sign of an immediate recession, then the understanding would be that yields should go back up and the dollar should go back up. And we're seeing that happen. Now, we're going to focus on the labor market for now. We'll get to all that stuff later. So, essentially, we've had the unemployment rate bottom out, back in 2023 at around 3.4%. It rallied to 4.3. It's gotten a little bit of a pullback to 4.1. But let's go look at some of the other labor market statistics, because that's only one. The unemployment level, if we go take a look at the unemployment level, it dropped by about 281,000, right? You can see a pretty big drop there. And you can even like isolate it into different categories and see that for say 16 to 19-year-olds, it's still going up, right? It's still going up, which makes sense because, if you look at the reason for unemployment, one of the main reasons that it's been going up is because of new entrants to the labor force not being able to find a job. We see that hires are down, so it's not that the people that have a job are getting laid off as much as it's just hard for people to find new jobs. And that's mostly affecting, say, new entrants to the labor force or re-entrants to the labor force. So 16 to 19-year-olds are having a harder time finding a job. But if you look at 20 to 24-year-olds, that actually dropped down a little bit. If you look at 25 to 54, that also dropped down. Now, if you go over to the unemployment level by reason for unemployment, job losers actually dropped a little bit right here. Now, this is one of those things where, like, in the grand scheme of things, this is still a general uptrend, right? If you look at, say, a 3-month moving average, I don't think you would look at this and say that, this past month was a huge change. But in the short term, obviously, markets react to those sorts of things. So we have to, we at least have to acknowledge that, look, that's a drop right there, and the markets in the short term seem to be on board with that and like that. Job losers on temporary layoff went up a little bit. On job losers not on temporary layoff went down a little. Permanent job losers went down again, also a little. And this is one of the charts that I've used to explain why risk assets have not yet cared that much about the labor market. And the reason is because this, while it's going up, it's not going up as quickly as it has in prior recessions, right? You can see here leading into the financial crisis, right? It was going up, but not really parabolically, right? It was moving up and then it went parabolic, right? And then it really took off. And so that's when the markets get concerned. Here it's just been a steady increase, right? We haven't actually seen that larger move up. And if you look at if you look at persons who completed temporary jobs, that actually got a pretty big drop this past month. Job leavers, slightly down as well. So here are the two that have been going up a lot. Well, re-entrance is not as much as new entrance. We'll see what the new entrance looks like. Re-entrance to the labor force, that actually slightly ticked down, but you can see it's been moving up quite aggressively from 1.74 million up to 2.16 million, over that half year or so, and then it's been coming down a little bit. But let's go check out new entrants. This is one that dropped a little bit. So it dropped 56,000, but you can see that this is the one that has really been moving up, since 2022, right? It bottomed out at 428,000 on the local top right now is 718,000. So that one's been going up. That one looks a lot more consistent with what you would normally expect in recessions. But I think the reason that it's not as big of a deal at the current time, or why risk assets have shrugged it off, as I said, is because if you look at permanent job losers, it hasn't been that same parabolic move, right? New entrants to the labor force has been parabolic, but permanent job losers has not been. And I think that's sort of the difference. And if you think about it, you know, the people that are going to mostly support risk assets are people further along in their careers who have good jobs. Those jobs pay a lot of money, and they use that to put in their 401ks and just invest in general. You have to imagine, right, that the 16 to 19-year-olds, say the new entrants, or the younger people or new entrants, therefore, they might not have as big an effect. So I think that is probably, what a lot of people are missing, is that the permanent job losers, it's an uptrend, but it's been controlled so far, right? It's not like what you saw in 2000. It's not like what you saw in 2008. This is one that, of course, we'll want to continue to pay attention to. The unemployment rate per state, this is one that we talk a little bit about. I'm not going to go through every single one. It's in alphabetical order, so it always starts off on Alabama. But that one basically just stayed flat. We'll go check on California. That one went up by about 0.1%. Not a huge increase. Delaware went up 0.1%. It's now at 4.2%. District of Columbia is up. This is one that has been a bit more concerning. It's one of the states that is the unemployment rate has been moving up a lot more aggressively, right? I mean, it bottomed out in 2022 at 4%, and now it's at 5.7%. If we continue on, Florida is always good to check in on. It basically stayed flat. If you look at Hawaii, I'm just clicking on some random ones. It's still flat from the last month. Texas, if we go look at Texas, you can see that one increased, or no, that one also stayed flat. It's been increasing, but it was flat this past month. And then maybe we'll click on one more. Let's go with Virginia, right? That one increased by about 0.1%. So, I mean, you can see that there are some states that look pretty bad, some states that look pretty good. And it's, I mean, if we actually look at it, number of states where the unemployment rate is rising over the last month, that metric has been going up, right? I mean, it bottomed out. I mean, it tends to bottom out right early in the year. Right here, it bottomed out in March, and then here it bottomed out in March, and then this past year it bottomed out in December, I guess. And then it moves up, and then you can see that it has peaked in September of the last 2 years, right? September and then September. Now, we just got the data point for July, right? So this is one of those, it's like a lagging thing, right? You're not going to actually get the September data for 2 more months, right? Because we still haven't even gotten the August data yet for the number of states where the unemployment rate is rising. And it also comes in at a different time in the month, right? This did not come in today. It came in like a week or two ago. So I would certainly keep an eye on this one. Now, if you look at it, that's over 1 month. If you look at it over 3 months, you'll see something very similar, right? Where let's just go straight to 6 months, where it really starts to pick up in April, right? April 2022, that's when it sort of bottomed and started to go up after that. Here was April 2023, it bottomed, started to go back up after that. And then this year, April of 2024, right? That's where it bottomed, and it's been starting to go back up again. So in this case, you can see that we saw the unemployment, or the number of states where the unemployment rate is rising compared to 6 months ago. It basically topped out. Here it topped in October, October/November of 2022, right? It gave the same data point of 31. And then last year it topped in November, December at 45. Okay, so this is going to be one where I think we should also look at, because it's been putting in higher highs and higher lows, right? Higher highs and higher lows so far. Here we can look at a map of the states where the unemployment rate is rising, and we can look at it over, say, the last month. So this first chart will show us over the last month, assuming it loads. Let me see if I can reload this to see if I can force it to load back here. This one's not. Okay, I think it's just we need to get the data in or something. We need to update it or something. But I mean, you can see that this is what it essentially looks like, right? We just haven't gotten the last data point in, but this is what it essentially looks like, where, parts of the country have the unemployment rate rising, but then there's other parts that don't look so bad, and in order to get a full-blown recession, you need to really see the entire country have the unemployment rate going up over the last half year, which is not what we're seeing at the current time. Alternative unemployment rate measures, percentage of the civilian labor force unemployed at least 15 weeks. That was relatively flat. Let's just keep moving on to some of these other metrics, right? So here's the employment level, and this is the establishment survey. The establishment survey actually increased by about 254,000, which is a pretty nice increase, right? If you look at it on a month-over-month change, this is what you want to see, right? You want to see people, basically, you want to see the economy adding more jobs. If you look at the household survey, you can see that it has been flat for a while, right? It's been flat for a while, but recently it's added a decent amount more, right? And so if you look at year-over-year comparison, this one went negative and now it's back to being positive, whereas establishment survey never even went negative, right? And it's not even really that close to being negative either. If you look at it, it's still, over the last year, there's still, if you look at all employees, 2.44 million over the last year in addition, right? Nowhere close to being negative, right? Where if you look at all prior recessions, that, when it goes negative, that's obviously the more concerning thing. And right, that's when the markets tend to sell off and tend to care. But you should know that, by the time this is negative, the markets have already priced it in, right? I mean, if you zoom in on any one of these, by the time, let's say it went negative, looks like it went negative, in May of 2008, right? I mean, the top had already occurred, half a year earlier, right? So it's not like you can look at this and be like, oh, I'll sell when it goes negative, right? Because by that point, it's possible that it's already over. In fact, I'm sure there's plenty of examples in here where once it went negative, that was when it was over, right? I mean, look at 1970. Once it went negative, the market drop was over, right? Look at 1974. Once it went negative here, the bottom was in. And this is the issue, right? I mean, it's true that there's a lot of data points that don't really support the idea of a recession right now. I mean, initial claims are low. The unemployment rate got a pretty big pullback. The counterpoint, of course, is that the stock market doesn't trade on what is, what's happening right now. It's trading on what's going to be happening in the next, say, 6 or 12 months. For me, I don't try to, plan or predict exactly when all that's going to happen. So for me with the S&P, I just DCA at below 0.75 risk and try to tune out everything else. But it just goes to show you how hard this stuff is, right? Even by the time the data tells you, it can be too late. But the counterpoint is you don't know how long it's going to take even for that to happen in the first place, right? There's plenty of periods where the market just stays above zero for years and years and years, and the market just keeps on trending higher. Non-farm private payroll employment level, that increased by 143,000. This is one that if you look at like the percentage increase year over year, it topped out at like 5.7% or so. It's now dropped to 1.32%. So it's definitely back in line with, sort of the pre-pandemic norm. It's even slightly below the pre-pandemic average, right? If you look at this average over here, we've dropped below that now, which is probably explains why the Fed did make an aggressive rate cut at the last meeting. Although now, you really have to wonder, because right before the first rate cut of 50 basis points, there was so much negative data, right? There was like negative 818,000 job revisions. There was the SOM rule indicator going off, right? So many different things. And then it seems like, and correct me if I'm wrong, but it seems like ever since the first rate cut, every data point that we've seen, or at least most of them, have made things look relatively good, right? I mean, you wouldn't even look at this data right now. You wouldn't look at some of this data and be too concerned based on just what we're seeing right now, right? Like if you just told someone, you know, 20 years ago that, hey, sometime in the future the unemployment rate will be 4.1%, we'll be adding 250,000 jobs. Should we be concerned about a recession? People will be like, no, right? So again, it's interesting how quickly the narrative can change from things look bad, we need to cut 50 basis points instead of 25, to, oh, the economy looks great. But remember, one of the things I said was the most likely outcome was the yield curve was likely underpriced. Like the long end of the yield curve was likely underpriced. I said we're likely going to see a big bounce after the first rate cut. And sure enough, the 10-year yield is getting a sizable rally, right? A sizable rally here. And I've talked a lot about this, how we often do see rallies by the long end of the yield curve in October, right? And it can top out in October, right? You look at the last 2 years, the long end of the yield curve sort of topped out at the end of October. But once again, we're seeing the yield curve rally, the treasury yields rally, the long end rally in October and after the first rate cut. And the reason why this is important is because if the long end, and this is the 10-year, if you look at the 2-year, I said that we'll likely see a rally by the 2-year. And the question was why? And a lot of people asked me why. And I said, well, look, guys, if there's not an immediate recession, right? Like if the Fed cuts rates and then there's not immediately the data to back it up, right? I mean, like, let's say today the unemployment rate came in at like 4.6%. Then obviously everyone would be like, all right, it makes sense why the Fed's cutting 50 basis points at the last meeting. It makes sense, well, they'll probably cut 50 basis points again and maybe 50 again in December, right? That would make sense. But now you have a 50 basis point rate cut. And now all of a sudden the unemployment rate's dropped 2/10 off its high. And, the establishment survey is up 250,000 jobs. And so the question then remains, and you still have real GDP trending at 3% or so. So then the question is, well, if the recession's not here now, and especially with initial claims back at, the 220s, if the recession's not here now, then what's the 2-year yield doing at 3.5%, right? And so that was why I said we'll likely see the 2-year yield rally following the first rate cut, because it doesn't seem like there's an immediate recession. And again, the business cycle can take years to play out, right? Absolutely years. So you shouldn't go into it thinking like, oh, well, this is going to play out by next month. I mean, this takes years. This whole thing might not be done until 2026, right? It takes a long time. In fact, I mean, the 2-year yield first entered this range back in 2022. So it's been a long time. It's been a really long time. So the 2-year yield is rallying, and the question then is, well, how high could it go? I would say I wouldn't be surprised to at least see it make it to the bull market support band around 4.1 to 4.2%. If it can get through that, then maybe back testing this, which would take it all the way up to 4.5%. So that's what I would be looking for as far as the yield curve goes. Now, the reason why that's important, and I'll talk a little bit more about this later, is because we know that the dollar and the 10-year yield has been pretty highly correlated. And so if the yield curve's going up, then that likely means that the dollar is getting a rally. And I talked a lot about this. I was actually pretty vocal about me being bullish on the dollar starting in October of 2024, just like, it made sense to be bullish on it in October of 2016. Right here, the dollar started a pretty nice rally. And then it continued on until the end of December. So I'm going to say base case, I think, is going to be that the dollar continues to rally through the end of the year, is my guess. Okay, that's my guess. And then I'm guessing it tops out at the end of the year, early next year, and then drops in 2025. So that's my guess. Now, if we go back over to the labor market, the total temporary help service employees continues to drop. So this has been a fairly steady decline, right? If you look at like a year over year decline, it's been negative, but it hasn't been nearly as quickly. It hasn't, deteriorated nearly as quickly as we saw in say some of these recessions over here, right? It seems like it's been a lot more controlled this time than in some of these prior ones. If you look at multiple job holders, I believe that actually ticked up. It's back up near the prior highs. If you look at job postings on Indeed, that's actually leveled out since May, right? It hasn't really moved a whole lot since May, so that's actually some good news, at least when you took at total job postings. Now, if we look at job openings, that one has been, continuing to drop, although this last month it actually went up, right? So, I imagine the Fed would like to see this stay above the pre-pandemic high of, the pre-pandemic levels right here, where we really didn't see it go much below 7 million, and it's already gone to 7.71 million. So certainly keep an eye on the job openings. I think probably out of this entire week, one of the most concerning metrics, because I mean, to be frankly honest, the labor market data that came in this week, a lot of it looks pretty good, right? I mean, a lot of it looks good. The only things that, are a little concerning are the job quits, right? If you look at the job quits rate, it dropped again, right? It's down to 1.9%. A lot of people might hear job quits and say, all right, well, if it's going down, that's good. But in reality, if people are not quitting their job, it probably means because they're not able to find new jobs. And you can look at the last 2 recessions and see that's when the job market, or that's when the quits were trending down. So this is the lowest it's been since 2015. So again, it kind of represents a market, a job market, where people that have jobs aren't really getting laid off any quicker than historical times that we've seen, but they're kind of nervous to leave because they're fearful they probably can't find a new job. And that's why if you look at like new entrants to the labor force or re-entrants to the labor force, those are trending up, right? Because people are having a hard time finding jobs. You can look at hires and see the same thing, right? Hires has generally been trending down. So this is one of those cases where people are having a hard time finding new jobs, but if you have a job, a lot of people have been fine just staying at the current job. They're just not going to leave it because they don't want to have to go back out in the job market and find a new one. Speaking of initial claims, what I just mentioned, initial claims are at 225,000. And this is one of those things where, like, if you just look at this, what's the concern? Now, I'm not going to say that it's not. I mean, it's possible that initial claims are putting in higher lows, but it's also possible they're putting in lower highs here too, from, the summer of last year to the summer of this year. So initial claims are still relatively low. In order to have a recession, you probably need to see initial claims in the 300,000 range, which we're not at and we haven't been at. So until that happens, I don't really think you call this a recession. If you look at initial claims per state, this is non-seasonally adjusted, so maybe we'll just go ahead and skip over. But if we look at a map normalized by population, the 2 states that have the most initial claims normalized by their population are New Jersey at 0.09% of their population and California at 0.1% of their population. If you look at the number of states where the percentage year over year initial claims is rising by at least 30%, only about 7 states. If you look at it, say, for 10% growth in initial claims, it's only about 15 states. Now, if we look at the map of those, here you can see the map rising 30% over the last year, and then here's the map rising 10% over the last year. Continued claims still remains relatively low. It even dropped again this past week, so nothing really to talk about there. Nothing's really changed. Continued claims map normalized by population. Again, the 2 states that have it the worst right now, California at 0.93% and New Jersey at 0.99%. And I think that's mostly it. I mean, we could look at the Kansas City Fed Labor Market Conditions Index, still trending down, but still well above 0. Actually, it might be good to go check in on the Somro recession indicator because it's still at 0.5. I think the question was has it untriggered because of this great print? It's now at 0.5, so it's still at the trigger point. So let's see what happens next month. Right? It's possible if the unemployment rate comes in low again, then it'll go below 0.5, right? So let's keep an eye on that for next month. If you look at the number of states where the SOM rule has triggered, it's been dropping recently. It's back down to 15. If you look, and there are times where it, goes up, comes back down, and then goes up again. But it has been dropping, which is a good thing. And then here's a map of the states where the SOM rule has triggered, right? Kind of this sort of the middle of the country. It seems like is where it's mostly triggered out, right in here. If you look at the smooth recession probability indicator, the odds that we were in a recession as of August of 2024 are only 0.34% according to this metric, right? So still relatively low. So that's good. If you look at the coincident economic activity index, still trending up, right? If you look at a year over year percentage change on it, it's at, 2.72%. Okay, so still looks fine. The composite leading indicator, I think, has started to roll over some. So maybe worth keeping an eye on that. Although it looks like if you were to look at, say, like a second derivative, it might not be dropping as quickly as it was. Let's look at a month over month change. This is just the derivative, right? But you can see that the rate of drop is actually getting a little bit better. So perhaps not too much concern there just yet either. So that's where we are, guys, with the labor market. Now, of course, the question is well, how is this going to affect risk assets, like Bitcoin? My general argument has been the same, right? I mean, Bitcoin right now is testing its bull market support band, and the better the job market, the more likely Bitcoin is to do well. Um, I think the counterpoint over a long enough period of time, right? I mean, in the short term, who knows what happens? Like in the short term, there's always a chance, right, that the long of the yield curve going up takes the wind out of risk assets for a few weeks before they go back up, right? Always a chance that happens. But overall, right? I mean, the market needs a reason to go down, not a reason to go up, because people, the markets generally trend up as a function of time, so they need a reason to go down, not a reason to go up. So I would say let's keep an eye on the bull market support band, because that is sort of the main line in the sand that Bitcoin needs to hold. Remember, this lower high structure has been holding for a long time. Last cycle, it was basically this week. It was after 29 weeks. It was this week where the Bitcoin broke through the lower high structure. Now, unless Bitcoin rallies to 68K in the next couple of days, it's probably not going to happen, right? It's probably not going to happen after 29 weeks like it did last cycle. But I would keep an eye on that, because there's two ways that this could easily go. And I think it makes sense to be hedged for both scenarios. The way you'd be hedged is, for that I've done is I think Bitcoin dominance is going to 60%, so I just keep the majority of my crypto portfolio in Bitcoin. Now, I do think ETH Bitcoin is in the process of bottoming, so I think it certainly makes sense to start hedging. But I do think Bitcoin dominance still will go to 60%. And you could argue that with all this great labor market data recently, why does the Fed need to cut? Right? I mean, I'm not saying they won't, but could the market not ask the question? And the market is asking the question. Now the market thinks there's a 0% chance of a 50 basis point rate cut, and actually a 4.3% chance that they don't cut at all. And you can't blame the market for asking that question, right? This is a reflection of the market caring less about the labor market all of a sudden, because the labor market looks okay, and perhaps weighing inflation reacceleration. Now, I don't really think we need to worry about inflation reaccelerating this early. I think if it's going to happen, it'll probably be, another year from now before that happens. But you can't blame the market for asking the question. And the reason why this is important is because if you go back and look at Bitcoin, and you look at Bitcoin dominance and all Bitcoin pairs, Bitcoin dominance goes up, generally speaking, when net liquidity goes down. And net liquidity goes down when the central banks collectively are reducing the size of their balance sheet and the dollar is going up, right? So now you have both, right? The central banks collectively are reducing their balance sheets and the dollar is going up, right? So if you look at net liquidity, it's starting to roll over again. And net liquidity, as we know, tracks, or all Bitcoin pairs have been tracking net liquidity fairly closely, right? You can even overlay net liquidity to alt Bitcoin pairs, and you can see that alt Bitcoin pairs have rallied for a while, but also net liquidity was rallying because the dollar was going down. Now we have a case where the net liquidity is starting to fall back down, and then does that mean all Bitcoin pairs are going to roll over? Now, there's a difference between net liquidity, as the way I'm defining it, the balance sheet of central banks, and the overall money supply, right? So if you were to look at an approximation of the money supply, it looks something like this, right, where it's been going up. And this is, I think, a common misconception on Twitter. You have a lot of people saying, well, net liquidity is going up. Other people are saying net liquidity is going down. It depends on how you measure it, and it depends on what your definition of net liquidity is. If you're talking about central banks measured in dollars, that's been going down. If you're talking about just the money supply, that's been going up, right? There was this wedge here, actually, that the money supply broke out of. Now, the question is, if the dollar continues to rally for long enough, then this could actually go back into this wedge. Because, again, it's a function of the dollar, right? We're converting into Japan, Euro, and Euro area and China back into US dollars. So if the dollar continues to rally, that would take the wind out of the sails a little bit. And remember, the dollar is pretty highly correlated with the 10-year yield. Okay, so it all depends on really, if the 10-year yield continues to rally, the dollar will probably continue to rally too. So all of this is still following the general blueprint outlined previously. And essentially that blueprint was just the 2-year yield rallies back up, right? After you get this, after there's no immediate sign of a recession, the 2-year yield should rally back up because, it's basically underpriced. And now it is, right? It's back up to 3.9%. And just a couple of weeks ago, it was at 3.5%. That's a pretty big move in only a single week, right? Pretty big move. In fact, the last time it made such a move from that level was back over here in September of 2022. And then by October, the 2-year yield was all the way up at 4.9%. So the yield curve can move quickly when it senses that it's, that a lot of things are mispriced, right? I mean, I think this was sort of like peak recession fear, SOM rule indicator going off, and the unemployment rate at 4.3%. And now all of a sudden you find yourself with the unemployment rates at 4.1%. And for some reason, the markets have priced in, all these aggressive 50 basis point rate cuts. And now the market's like, wait, hold on a second. What's going on, right? Why do we need all these rate cuts if real GDP is where it is and the unemployment rate isn't trending up? So now those rate cuts are starting to not become as aggressive, right? Just a couple days ago, there was about a third, 1/3 chance that the Fed funds rate would be at 4% by December, and now the market is saying a 0% chance of that happening. And as those rate cuts get priced out, right, as they get priced out, it means that alt Bitcoin pairs start to struggle, because you could argue one of the reasons alt Bitcoin pairs were doing well for the last few weeks was because of all the rate cuts getting priced in, right? You could argue that is what allowed alt Bitcoin pairs to make that move. But if those rate cuts are starting to get priced out, does that finally mean that alt Bitcoin pairs make the final move to the range lows, right? Which is the same move they make, every single time, right? Where they eventually go down to the range lows. And I think that is the way, I mean, potentially, because I do think dominance is going to go to 60% in Q4. And that means that, I think that all Bitcoin pairs will take this, take that plunge. Of course, the question is this coming on a Bitcoin rally or is it coming on a Bitcoin dump? Last cycle, it basically occurred on a combination of both, right? It occurred on a combination of rallies and dumps, right? It was all throughout here, and that's what sent the dominance higher. Same thing has happened this cycle, right? Same exact thing throughout here. Bitcoin's basically been flat for over half a year, but dominance has gone up a ton over that time period. So I think whether it's, leading into Q4, is it a rally or is it a dump? It could be a combination of both, which is what we've been seeing for the last 6 to 7 months. If it's a rally, then Bitcoin needs to hold above the bull market support band and hold it as support, right? And it's not impossible, right? I mean, it's certainly possible that's what happened. If you actually look at the year-to-date ROI of Bitcoin, if it loads, if you look at 2024, it's actually right where it was at this point in 2016 and in 2020, in fact, right? It's at the same spot. So it's certainly possible that Bitcoin follows that path, right? Where it just rallies in Q4 and slowly takes out this lower high structure. That's actually what it did in 2019 too. At the end of 2019, it did take out, or sorry, at the beginning of 2020, it did take out the lower high structure, and then you had the hard landing, right? But it was after that lower high structure was taken out. I think for me, the hard question to ask right now, and this is the question that I think you either, a lot of people fall into one camp or the other. I think you should have some hedging for both scenarios is, has the lower high structure completed and we're just in the process of taking it out, like right here, right? Is that where we are right now? Or are we here just after rate cuts, right? Because I mean, again, last cycle, the market rallied for 2 weeks after the first rate cut, and then it sold off, right? You got a red candle, and then the next 2 weeks were red as well. And then you got a green candle, right? So if you look at it today, right, we got this is where the Fed cut rates. The market rallied for 2 weeks. It sold off following the rate cut. So now I guess, here's what I would say. If the next 2 weeks are red, like this, right? If the next 2 weeks are red, and then you get another little pop in early November when the Fed cuts maybe 25 basis points, then I would say it's more likely that we're here, right? So if the next 2 weeks are red for Bitcoin, it's more likely that we're in August of 2019, and as it relates to monetary policy. If, on the other hand, the next 2 weeks are not red, and Bitcoin rallies up here and breaks through, then I think you make the argument that we're here. Right? I think that's what you would argue. So I think, and I don't think anyone knows the answer, but I think that's what you have to look at. And again, monetary policy doesn't always play out the same way every single cycle, right? I mean, 2016 and 2020, Bitcoin went up in Q4. Counterpoint to looking at this halving year stuff and saying it has to play out the same way is that if you were to look at, dominance without stablecoins, and you looked at 2016 and 2020, it would have told you dominance was going to go down this year. But in fact, dominance has gone up. So again, the halving year stuff, the halving is important. Monetary policy is also important. A lot of people fall in one or two camps. They either think the halving is important or monetary policy is important. I think both play a role, right? There's no denying that there's hype around the halving and it brings new people into the space. But there's also obviously an effect of monetary policy too. So where does Bitcoin need to get through in the short term to rally in Q4 as opposed to, say, sell off to the 100-week SMA? Because you have this scenario here where after rate cuts last cycle, about a couple months later, right, rate cuts were here, and then a couple months later, Bitcoin fell to the 100-week SMA, right? So now you have rate cuts here. Will Bitcoin fall to the 100-week SMA a couple months later? What do we need to get through for that to not be as big of a fear? In the short term, Bitcoin is probably going to face resistance at this level, right here, around 63K. That was the prior support. Bitcoin held this support on, September 20th and September 22nd, September 26th, and then October 1st. And now it's below it, right? So if it rallies back up to 63K, that'll be sort of the first milestone. Coincidentally, though, 63K is approximately where the bull market support band is, or at least the 20-week SMA, right? The 20-week SMA right now is at 62.7K. And then the last thing is the 200-day SMA, right? The 200-day SMA is at 63.6K, which also actually happens to correspond loosely to where Bitcoin rallied back to over here, right? So if you look at this low right here, back in June, Bitcoin rallied off of this low, right? Same thing. And when it rallied, it went all the way back up to 63.8K, right? That level is basically the 200-day moving average. You see that? So I would say that 63 to 64K is going to be the big level, right? If Bitcoin can get back through that and put in a higher high again, then it definitely raises the odds of Bitcoin continuing to go up in Q4. If Bitcoin just finds resistance at 63 to 64K again, then there's more evidence to suggest that it's just playing out like it did after rate cuts last cycle, right? Where you get a couple weeks rally, you get an impressive rally, but the market just sells off after it because it's not enough. And I guess that's the counterpoint. That's the counterpoint to everything. In inherently the labor market data is good, right? Inherently, you want to see the labor market do well. You don't want to see people lose their job. The counterpoint, of course, is if a lot of companies are relying on aggressive rate cuts, and now they're like, crap, we can't actually rely on that now. Perhaps that's the counterpoint that makes sense to be aware of. But the thing to think about is if that's the case, right? If that's the case and risk assets don't go up in Q4 and they get another drop like they did, and instead of a 6-month consolidation, it's a 9-month consolidation. People might think it's because of recession, and it could be. But what if it's just because of a repricing of the yield curve, right? If the long end goes up, then it might just make that more attractive to some people in the short term. Risk assets get repriced at because interest rates have gone back up, and then 2025 Bitcoin dominance finally goes down, and the riskier stuff finally starts to outperform Bitcoin. That's kind of what I'm thinking happens, right? But we'll see. We'll see where it goes. In the short term, I definitely think it makes sense to be hedged for either outcome. For me, that means it's basically just been staying mostly with Bitcoin for the last several years. Again, with ETH Bitcoin below 0.04, I honestly, I think it makes sense to hedge those views, obviously, as I've said. But that's where I currently stand on the market. And we'll see what happens, right? We'll see what happens here with Bitcoin. And let's see if Bitcoin, where it closes with regards to the bull market support band as we get into the weekly close. Okay? The weekly close will be in a couple of days. 2 days and a few hours from now, at least from when I'm recording this video. So we'll see where Bitcoin closes that. If it can hold it above the 20-week SMA for a few weeks, that would bode well for for the rest of Q4. But if it does this, where it just slowly bleeds back down after your rate cut rally, then I think you could very well be setting up for a drop back to the 100-week moving average, right? So that's what I would look for in Q4. We'll see what happens. Thank you guys for tuning in. Make sure you subscribe, give it a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.